The stock market can seem intimidating. It's a world of numbers, charts, and jargon. But don't worry, you don't need to be a financial whiz to understand the basics. This guide will break down the fundamentals of the stock market. You'll learn how it works and how to start investing. Think of this as your crash course to building wealth. Investing is one of the most powerful tools for growing your money. It's how everyday people build towards their future. Whether it's a comfortable retirement, a down payment on a house, or simply financial security, investing can help you get there. It's about taking control of your finances. The stock market is a journey, not a sprint. There will be ups and downs, but with the right knowledge and approach, you can navigate the market confidently. So let's dive in and demystify the world of investing, one step at a time. It's time to take charge of your financial future. The stock market, at its core, is a marketplace where buyers and sellers come together to trade. Just like a farmer's market sells fruits and vegetables, the stock market sells pieces of companies known as stocks or shares. These pieces or shares represent partial ownership in a company. Owning a share means you own a small slice of that company, giving you a stake in its future. Think of it like this. Imagine your favorite pizza place decides to expand. They need money to open new stores and grow their business. To raise this money, they divide ownership into thousands of shares and offer them to the public. When you buy a share, you're essentially giving them money to help them grow and expand. In return for your investment, you become a part owner of the company. As a part owner or shareholder, you participate in the company's success and growth. As a shareholder, you have a vested interest in the company's performance. If the pizza place thrives and its value increases, so does the value of your share, potentially leading to profits. You could then sell your share for a profit if the company's value has increased. Of course, the opposite is also true. If the company struggles, your share value may decrease. If the company faces challenges, the value of your shares might drop, leading to potential losses. Understanding this basic concept of ownership is key to grasping how the stock market works and making informed decisions. It's not just about abstract numbers on a screen, it's about real ownership in real companies. This ownership is tangible and represents a piece of something real and valuable. This sense of ownership is what drives the market's dynamics and influences investor behavior. Imagine a bustling auction house with people frantically bidding on antiques. The stock market is similar, but instead of antiques, it's shares of companies being bought and sold. This constant buying and selling determine the price of each stock. When you place an order to buy a stock, you're essentially shouting, "I'll buy this share at this price." Simultaneously, someone else might be yelling, "I'll sell at that price." When your buy price matches a seller's asking price, a trade occurs. This entire process happens electronically on stock exchanges like the New York Stock Exchange or Nasdaq. These exchanges act as platforms connecting buyers and sellers from around the world. It's a highly efficient system driven by supply and demand. The price of a stock fluctuates constantly throughout the trading day. This fluctuation is influenced by various factors such as company news, economic indicators, and overall market sentiment. Understanding these forces is crucial for making informed investment decisions. There are two primary approaches to participating in the stock market: long-term investing and short-term trading. Both involve buying and selling stocks, but their timelines and strategies differ significantly. Long-term investing is like planting a tree. You choose a company with solid fundamentals and hold on to its stock for years, even decades. You're essentially betting on the company's long-term growth potential. Just like a tree grows slowly but steadily over time, your investment compounds and generates wealth over the long haul. Short-term trading, on the other hand, is more like flipping a house. Traders buy and sell stocks within short periods, sometimes even the same day, aiming to profit from quick price fluctuations. It's a fast-paced, high-risk, high-reward approach that requires significant time, skill, and market knowledge. Choosing between these approaches depends on your financial goals, risk tolerance, and time commitment. Long-term investing is generally considered less risky and more suitable for beginners. It allows your investments to weather market volatility. Short-term trading requires more expertise and carries higher risks. Section 5. Don't put all your eggs in one basket. Diversification and risk. Imagine putting all your money into a single stock, hoping it skyrockets. While this sounds tempting, it's incredibly risky. If that one company falters, you could lose everything. That's where diversification comes in. Diversification is like having a safety net for your investments. It means spreading your money across different asset classes like stocks, bonds, and real estate. Within stocks, you further diversify by investing in various sectors like technology, healthcare, and energy. Think of it as building a balanced breakfast. You wouldn't eat only cereal every day. You'd include fruits, yogurt, and other options for a well-rounded meal. Similarly, a diversified portfolio ensures that even if one investment performs poorly, others can cushion the blow. Risk management goes hand in hand with diversification. It involves understanding and mitigating potential losses. This includes setting realistic investment goals, having an emergency fund, and avoiding impulsive decisions based on emotions or market hype. Section 6. Your first trade. A step-by-step guide to investing. Ready to dip your toes into the stock market? It's an exciting journey, but it requires careful planning and knowledge. Here's a step-by-step guide to get you started. First, educate yourself. Knowledge is power. The more you know, the better decisions you can make. Before investing a single dollar, take the time to learn about different investment options, risk management, and basic financial concepts. This foundation will help you navigate the complexities of the market. There are countless resources available online, at your local library, and through financial literacy programs. Utilize these resources to build a strong understanding. Second, determine your goals and risk tolerance. This step is crucial as it shapes your investment strategy. What are you hoping to achieve through investing? Are you looking for long-term growth or short-term gains? Are you saving for retirement, a down payment on a house, or your child's education? Each goal may require a different approach. Understanding your goals and how much risk you're comfortable taking will guide your investment strategy. It's important to be realistic about your risk tolerance. Third, choose a brokerage account. This is where you'll conduct your trades. A brokerage account is like your gateway to the stock market. It provides the platform for buying and selling investments. It allows you to buy and sell stocks, bonds, and other investments. Make sure to choose a reputable brokerage. There are numerous online brokerage platforms available, each with its own fee structure and features. Compare these carefully. Research and compare different options to find one that suits your needs. Look at fees, user interface, and customer service. Fourth, fund your account. Once you've chosen a brokerage, you'll need to transfer money into your account. This is your investment capital. Most platforms allow you to link your bank account for easy transfers. Ensure you transfer an amount you're comfortable investing. Finally, start investing. With your account funded, you're ready to start buying stocks. This is where your research and planning come into play. Remember to research companies thoroughly, diversify your portfolio, and start small. Diversification helps manage risk, and starting small allows you to learn without significant financial exposure. Section 7. Rookie Wisdom Tips for New Investors. Navigating the stock market as a beginner can feel overwhelming. The sheer volume of information and the fast-paced nature of the market can be intimidating. Here are some practical tips to help you get started on the right foot. Start small. Begin with a modest amount of money that you can afford to lose. You don't need a fortune to begin investing. Even a small amount can grow significantly over time with the right strategy. Many brokerage accounts allow you to buy fractional shares, meaning you can own a portion of a stock even if you can't afford the full share price. This makes it easier to diversify your investments. Think long-term. The stock market is a marathon, not a sprint. Patience is key to seeing your investments grow. Avoid getting caught up in short-term market fluctuations. Daily market news can be distracting and often irrelevant to your long-term goals. Focus on building a diversified portfolio for long-term growth. Diversification helps spread risk and can lead to more stable returns over time. Do your research. Before investing in any company, take the time to understand its business model, financials, and growth prospects. Knowledge is power in investing. There's a wealth of information available online through company websites, financial news outlets, and research platforms. Utilize these resources to make informed decisions. Avoid emotional decisions. The stock market can be volatile and it's easy to get swept up in the highs and lows. It's crucial to make rational decisions based on research on your investment strategy, not on emotions like fear or greed. Stick to your plan. Don't be afraid to ask for help. Investing can be complex and there's no shame in seeking advice. If you're unsure about something, don't hesitate to seek guidance from a financial advisor. They can offer valuable insights and help you navigate the market. A professional can provide personalized advice and help you create a financial plan tailored to your specific goals. This can give you confidence and clarity as you embark on your investing journey. Section 8. The future is now embracing your investment journey. Congratulations! You've taken the first step towards securing your financial future. By understanding the basics of the stock market, you've empowered yourself to grow your wealth and achieve your financial goals. Remember, investing is a journey, not a destination.